But for those of you that aren't familiar, I'm Larry. I'm the host of Tech Talks. That's SRM Tech Talks. We talk the intersection between traditional finance and emerging fintech and technology. And so what we're looking to do is find great solutions out in the market of people who have innovative solutions, usually solving some sort of a problem, and bring them to the financial services industry. And today we have Rob Goodyear, who's the CEO of a company called aaim. Rob is very familiar with the fintech space and banking in general. Known Rob now, I think we've known each other for a few years. It seems like a lifetime, but I think it's only been a few years. We spent a lot of, yeah, I'm not sure how to take it either. We spent a lot of time talking to each other. Rob's a good friend, a bit of a colleague almost, and really appreciate him coming on and talking about, let him describe what we're going to be talking about today, but a little bit about opportunities for community banks and credit unions to provide almost wealth management-like solutions for the 99% of their customers and members that don't have that offered today, right? So typically we all know that if you're a financial institution, you might have 1% of your clients are members that are in some sort of wealth management program, but really the rest of everyone else is left on their own to go to the Robinhoods of the world, the Coinbases, and maybe they invest a little bit through their 401k. But certainly as they built any assets, and particularly if they're non-traditional assets, their ability to use those assets and leverage them and borrow against them, get liquidity out of it, the way that more wealthy individuals can borrow against their stocks and other assets. That's a missing piece of the puzzle for a lot of folks out there, just the average folks. And it's important to consider, especially given that there is $70 trillion plus of assets sitting with the baby boomers that are going to pass down to the next generation, probably within the next 10 to 15 years. I think my parents are in that ballpark. Hope they live forever, but realistically, we are going to see some assets pass to other generations. And that's important because if you don't have a relationship already with those individuals and those assets come on board, you're not going to benefit from that, right? Those aren't going to show up as deposits. They're not going to show up as investments. And so there's a real missed opportunity, I think, today with folks that don't have those offers and really aren't endearing themselves to those people through building these kind of relationships. So with that, I'll turn it over to Rob. Rob's got a very conversational style. I think he probably might have a few decks to share, but that's really up to Rob. And with that, I'll hand it over to you, Rob. And we've got a number of people on the call. Obviously, feel free. Are they okay to ask questions as we go through this, or would you prefer them save that till then?
I encourage it. No, I encourage it because I want this to be a dialogue. And before I get into story time, let me just set the stage a little bit. We're an early stage venture-backed fintech, and I am adamant about co-creating with people like everyone on this call, right? It's vital to me to be able to have a feedback loop from my customers.
Yeah.
And I've got a really strong opinion about, of course I do, that Larry. I have lots of those. But I have a strong opinion about founders who think they've got it all figured out. And I've been there myself, learned my lesson. And the ability to listen aggressively and synthesize and process what you're hearing. Because everybody's going to tell you, hey, yeah, I like that, or I like you, or that's cool. Nobody wants to give you the hard news very easily unless you're there with the ask for a contract or money. Us founders will spend a whole lot of time in an echo chamber of yeah and backslapping. And that's not good. That's the wrong signal. So I prefer to build in public, go early, recruit hard, looking for people who are interested in co-creating, building something together. Now, of course, in the banking and financial industry, there's a whole lot of risk involved, but there's absolutely nothing wrong with paper prototyping with executives in the CEO banking space and regulators. So that's what I've been doing. For about a year, I've been building this company called aaim, largely self-funded. I got a little bit of prior investor seed angel investment in. I made a run at traditional VC beginning about April. And not being an AI specific or AI focused company, that was an interesting journey. So I can read the room and went back to focusing aggressively on finding good partners, good distribution channels, co-creating, building in public. And then I'll go back to traditional venture when I need 10 million, not 1 million. That's the current status of the company. I have a wonderful partnership with CU Wealth Next. I'm alongside a couple of fantastic other companies that are jigsaw puzzles that snap together with me quite nicely. Larry, one clarification I want to make. I'm actually not providing or delivering investment products per se. My role, if I pull it off correctly, is to be connective tissue or plumbing between brokerages, investment products, issuers, introducers, et cetera, and an individual's post financial institution. The play is I want to open up access to liquidity, as you said, Larry, for regular people so that they can have that kind of relationship with that banker or credit union executive that the ultra high net worth people do, right? And now slip into story time. If you imagine Alice is a local pillar of the community in any town, USA. She's well known to everybody. She owns a string of car washes and has gone multi-state with it. Got a lot of stuff going on. She sees an opportunity to acquire a dry cleaner. That conversation that she can have with her banker is smooth as silk. It probably happens over a meal somewhere, not in a boardroom. And it probably goes, Bob, the banker, I really want to pounce on this opportunity to acquire this dry cleaner. I need 50 million. I'd be happy to liquidate some of the car washes, but it's summertime. It's throwing off a lot of cash. I really want to take down that cash flow right now and liquidate slow, but I really need to pounce on this acquisition of this dry cleaner. And 8 days a week, twice on Sunday, the banker is going to say, absolutely. And a lot of that is built on that interpersonal trust, like you pointed out, Larry, that relationship. Of course, there's diligence. I'm not wanting to suggest that any banker or credit union executive is fast and loose with anything. But the data points available by that long relationship with someone in the community has a lot of value. It speeds up and increases the interest of the loan committee, underwriter, board, what have you, to take a deeper look at the asset. And they get that deal done. I want to use technology to scale that out to everybody else. I want to make it efficient and economical to surface that kind of data at normal people like me scale, so that a banker can introspect the value of the things that I've done that aren't on their ledger, potentially look at assets that I hold over at Vanguard and Fidelity and a couple of private investments, some early stage equity, some unexecuted options, et cetera. I have created a universal protocol to assess value, standing on the top of the shoulders of other protocols, but to add some extra dimensions to that. And Larry, you're raising your hand?
I am, and you're probably going to go into this. Is this similar, like from a relationship standpoint? I bought a bunch of houses over the years, and the detail of identifying all of my assets and where they are, and some of them are on ledger, some of them aren't on ledger. A lot of that has to do with the relationship with the banker that I've built. But that is an arduous process for anyone that's gone through that, right? And that takes a lot of time and a lot of effort. And not everyone has. Maybe not everyone keeps as good a track of all of their assets, or maybe their assets aren't as liquid. So is what you're suggesting a way for kind of the average person to not go through that pain and suffering of a 2-week process of pulling all of your numbers together to buy a house and prove that you've got these assets, but more to say, what are those assets that an individual might have, and how can we build liquidity off of that for maybe a short-term financing needs or something along those lines?
Yeah, that's absolutely right. And let me ask you, how would you do that now?
But oddly enough, I'm going through that process now. And it is
And how much of that is automated?
None of it is automated. And in fact, like even some of it is questionable, right? So let's say I've got a reasonable amount of digital assets and I might have to liquidate those. So the banker is comfortable with the fact that those things are sitting in a bank account and not on the ledger. Like those are some of the complexities of someone like myself. Everyone's got some level of complexity, but none of that is automated. The pre-approval process of getting a mortgage was fairly quick and painless, but when it actually comes in time for the bank to finance, they want a fair amount of history on you. And again, I've got a lot of that already downloaded in spreadsheets, those sorts of things, but not everyone has that.
That's right. And now tell me, who is the arbiter of fact in your spreadsheet? And the answer is the onus is upon the underwriter to go validate everything, isn't it?
It is.
Now tell me if that's worth it at scale. So
Yeah.
the point here is not to take a bunch of highly illiquid or exotic assets and glue them together to substantiate a mortgage. That's a fringe edge case. But for regular people to have the automated underwriting or asset estimation done and to be talking to their loan officer, banker, what have you. And the loan officer says, yeah, you need the 850K to buy this property. We really want you to, we talked about 40K down payment. We'd really like you to crank that up to 60, 65K. What's the person going to do? They have a couple of options. One is erode more liquid cash to meet that threshold. Or if the light bulb goes off in their head and says, wait a minute, I've got this old 401k that I forgot about. And I've got these dusty stock certificates in the safe that I didn't know what to do with. So the point here is that I've built a protocol that can throw a lasso, if you will, in the loosest terms possible, to begin to put form and structure to that information, to do things like Plaid, or do you remember Mint does, to have low friction data sharing agreements with people like Fidelity or Schwab or Vanguard, that of course is highly permission model based by the consumer, to say, hang on, let's go pull all these other things. And then this piece of paper and then this weird thing, I don't really know what that's worth. Let's pull that together real quick. Right. So it's the idea of no spreadsheets, because Larry, your spreadsheet came from a valid, live, modern data source, I'm sure, right?
Yeah.
Okay. So forget that needs to be automated. And of course, again, there are places that do this. There are places that help you aggregate. Data aggregation / scraping / the Plaid model is as old as the hills. That's fine. But the real interesting part here is beginning to understand the potential value of less liquid things. And I absolutely do not want to be a lender. I absolutely do not want to be a marketplace to liquidate things. My entire reason to exist is to surface that data and to give the lender a dashboard or some recipes, if you will, to control their tolerance for risk, to control the types of things that they would even bother looking at. And if those conditions fit a specific model, great, automation just happened. Do you have a question, Larry?
I do. Is it fair to say that most individuals don't realize that they can do things like borrow against their stocks or borrow against 401k or borrow against certain assets? Is that part of an opportunity as well?
There's certainly an education opportunity, and that's a big problem with the industry at large. And of course, you can go borrow money from your Fidelity or Vanguard account. Up
Right.
until a few years ago, things like that required a wet ink signature and FedExing, and then a penalty, and then a this and a that, and a lot of time. I don't like that model, that penalty-based model. Certainly, brokers like Schwab, for a high net worth individual that's got a decent amount of assets under management at Schwab or self-directed, they'll do an pledged asset loan, minimum $100,000, minimum overnight plus 4.4%, I think. So mid 9% interest. I do not believe that they ratchet down and by the way, they will only accept high quality, top of the list equities. You can pledge them in and lock them up in this contract. I do not think they ratchet down the contract if you make payments. Products like that exist for high net worth people that need to execute a transaction, grab $500,000 for 40 days and repay that quickly before the interest really bothers them. That's that 1%er case.
Yeah.
Those people don't need this. those people have the relationship that I started with my story with, which is to say, I can get that done for a song. And it's an expression of the rich get richer. Of course they do, because they have access to liquidity and they have that rapport and high bandwidth dialogue with a banker. And that's it. That's what they need, because it makes sense for the banker to lean in and treat them like a private banking customer. Did that answer the question?
Does.
My product intends to be an information source, a recipe management dashboard, so that the institution is lending their money. I do not wish to find outside capital as a loan funding source for institutions, because I'm not going to die on this hill, but I'm going to continue to bang the drum of this industry. Everybody on this call deserves to claw back the market share that the rando fintechs have stolen. I think that's the nicest way I can say that without you having to bleep me out later, Larry.
Yeah, and I appreciate that.
It's a flywheel of revenue, though, is the thing. Like, you've got deposits on book, you've got people, you've got relationships. So let's amplify the relationships with the people / your depositors, and let's open up access to the relationship that, again, normally exists at scale. I'm using technology to scale that out.
So, Rob, how are institutions or are institutions doing this today? Are the big banks doing this? Is it the small banks and the community banks and the credit unions that aren't? Who's providing these? Obviously, like private wealth management, private bankers provide those solutions today. But is there anything like this in the market from a solution standpoint?
There's a company, they've been making a run at this for a few years. They enable outside capital to fund a loan at your institution. I don't think that's not holistic. That's not the right word. I don't think that's an industry changing movement. How's that?
Is that almost like a peer-to-peer lending where they're just finding small investors that are willing to fund a loan? Because you said outside capital. Is that what they're basically doing? Is like
I'm not aware of what's on the other side of the transaction. All I can say is my role is to put the existing institution's deposits to work.
Got it.
I also don't want to get in the middle of loan flow and stuff like that. If there's so much to win by shining a light on existing data and the existing relationship between the person and the institution. And we don't have enough time for this, but I could go on for hours about the ideas of tangential relationships, right? If we want to talk about neobanks, non-banks, again, not enough bandwidth for what I'd have to say about that, but poisoning your KYC integrity, even counterparties to the transaction. For example, if a company did pull in outside capital to fund a loan, and what assurances do they have as the source of those funds? It'd be real easy to have some mysterious liquidity pool, cash pool outside to go fund a bunch of loans and spray loans all over the country. What's the provenance of that money? So we have enough problems in that space right now. I think a lot of that can be solved with what we have right now. And I'm sorry, when I say we, I mean you guys and gals. What the industry has right now is a whole bunch of deposits, a whole bunch of depositors. There are so many things we can do to improve things. And of course, every fintech on the planet is here to tell you, we've got the solution, we can fix things. There are a lot of those transactional spaces that they're solving things for that honestly, they impart too much risk to what I want to do. I want to firm up the relationship between existing counterparties and then again, use technology. I guess I'm going to correct myself and say I'm using AI because I do have a healthy amount of AI and ML in to speculate potential value of more illiquid assets that someone may have. But I can do that because my job is to give the institution a set of starter recipes, if you will, so they can turn the dials and move the levers on their risk tolerance, manage the things that they think are worth putting money to work against with their consumer, with their depositors.
What other benefits does it help the financial institution? So obviously deepen relationship. Does it do anything in terms of retention of customers or members?
It's really easy to make that leap for sure. Just ask the question backwards. When when my potential story said that a person went in looking for 850K and got told they need to put another 25K in, if none of the previous and only existing options are palatable to them, what do you think they're going to do? They're going to go shopping for a direct lender or elsewhere. So I think that answers the question.
Yep.
I of course am going to be egotistical and say it would absolutely attract new customers. As a former consumer products guy, life cycle CRM guy myself, I'm already working on a bunch of campaign in the box type of tactics that customer financial institutions could deploy to communicate this to the community. So I absolutely believe it can bring people through the door, but I'm starting small. I want to focus on putting a lens on things that, like you just described. And by the way, audience, Larry and I didn't work on that use case that he just described with his spreadsheet. We did not work on that before the call. I was not aware of that, but you pointed at the problem. You've got to go download a bunch of stuff, hand over papers. The person holding the pen has to trust but verify. That's a mess, and it makes no sense. So there's a second and third wave of the product that I'll talk about for just a minute. At scale and with enough great partners, I hope to work with a company called Investify that's providing a retail investment platform product to the consumer. My friends at Concrete who do a fractional REIT product. My APIs are designed to allow a consumer to pledge those assets into the underwriting conversation. And when I say pledge them, it starts at various levels, but the easiest one is to say, this brokerage is sharing information with the bank or credit union to speed up the conversation. It gets better when the participating brokerages can encumber those assets and just put a do not sell flag on there. It gets even better. Let's add a 0 or 2 to the principal amount that Larry was talking about. When it gets big and worth doing, I've also built a protocol that will allow a third-party custodian to basically get into the conversation and throw a tri-party custodial contract around an asset and be the arbiter of fact in case of default or some other situation so that they can custody the asset on behalf of both the depositor and the institution. Because I don't want the institution also to get into custodial position, get into a space that they don't need to be getting into. Because the idea of grabbing assets in real time and liquidating them or potentially liquidating them, it opens up a whole bunch of securities law that nobody wants and needs, right? So when we've got all the right counterparties doing the right things, it also insulates the institution from risk. It doesn't start to bring things too far into the four walls of the institution itself.
I was just, you'd mentioned Investify. We've had them on, obviously, our tech talks in the past multiple times. They're going to come on September 12th. Also, we've had Concrete. So if anyone wants to go back and look at that one that was recorded. And then you mentioned CUL Tech as Josh, who used to work with us, is a CEO over there. And to your point, he's putting together a number of puzzle pieces to provide a holistic set of solutions for credit unions, particularly credit unions. I don't know about community banks, but certainly credit unions that they don't have access to today.
Yeah, we are a loosely coupled group of like-minded companies that CUL Next is standing up relationships with. I see us all as best in class alone, but better together. And that kind of, I hate to sound like the young kids, defrictioning, or let's just say symbiosis, is really what this industry needs. Because look, the fintechs and non-banks, they have sold the world on the idea of frictionless everything, right? They've made things shiny and pretty and cute. But that's coming around to haunt a few of them, let's just say.
So Rob, you've got an asset-based risk management platform that I think you're offering a way of kind of monitoring the value of investments that may be on or off platform. And I think in some of the stuff you shared with me before, even attached collateral agreements. how does that monitoring work? Is that via API calls to all of these other solutions? Or I'm not sure.
Yep.
I'm trying to wrap my head around how that works.
Sure. Sure. So again, think about the Mint model. Think about the aggregator model. That's widely known. That's been done. I'm not exactly sure why Mint as a brand cratered and got withdrawn back into Intuit. I'm not sure. I think they punted it over to Credit Karma. I don't understand that. I would love if anybody on this call has any intel or an opinion on why they did that. But Mint did a great job of understanding the spot value of everything you had that it could connect to. So that's table stakes. The API integrations with brokerages, custodians, et cetera, that's easy. That's just time. The interesting part is because I am talking about things that aren't so easy to just put your finger on, right? And that's things that may have a potential value, things that may have a long time to liquidity horizon. And those things are where the algorithms come into play. That's where AI and ML come into play. So to answer your question, we've been working for about 11 months on a bunch of algorithms, understanding different oracles and signals in the marketplace. And everybody else is doing this with trading, right? Everybody else is trying to throw AI at trading wizards. That's fine. I can do the same thing for things not for the purposes of going and trading them, but to understand what the risk is to the institution if they needed to liquidate that, grab a hold of it and liquidate it. Like even the mechanics or the dynamics of having to legally seize an asset and liquidate it, it's part of the model. How difficult is it? Because look, banks and credit unions, they have a blunt instrument of default and repossession and disposal of assets. I don't think anybody likes that. I don't think it's a fun process. It's salvaging pennies on the dollar. It just has to be what it has to be. So understanding again what the pain and the overhead expense of having to do the unthinkable is also part of the models that we're building.
So Rob, I would assume for different assets, they would have different loan to asset ratios. Those
Yep.
are things that we calculated all the time. Those assets could change in their risk level. So those would get recalculated. You're talking about it. If it drops to a certain amount, like a margin call, right, then there's a liquidation that goes into play, or a customer or a member would have to pony up additional dollars so they don't lose those assets that they've borrowed against. But to going back to the Mint example, I don't think Mint ever monetized. Like, how is Mint monetizing their data? I'm assuming they were selling it to someone, but they never did unlock the value, which is what you're talking about, is unlocking the value of that trap liquidity, right?
No, in the Mint model, you were the product. As they say, if you can't figure out what the monetization model is, you are. Yeah, it's you. So I could totally guess that basically you get 1 million active users, it's $1 billion company. That old metric it still works. So of course, and that intelligence of understanding behavior on other platforms, that's worth more than just the eyeballs of the people that were.
Yeah, because then you can use it for targeting from a
Yeah.
competitive standpoint and those sort of things.
Yeah, and to that point, I absolutely overly philosophical about there's enough money to be made in facilitating this for the banks and credit unions that the idea of brokering even anonymized intelligence outside is silly to me. This industry doesn't need more of that. This industry doesn't need the risk. Yeah, I'll raise my hand and say that's not something that I'll ever let happen as long as I'm here. It's just the business people or the VCs grind hard to get things like that, other dimensions and other monetization streams. And that is, again, I could go on all day long about the fintechs, Robinhood, and it's not pro consumer and it's not pro industry, honestly. It's very con everybody involved.
Rob, how big is the market? Like investment, neobank, financial app revenue? What's the serviceable market? What's the attainable market? How big is the funds for community banks and credit unions?
Yeah, everybody knows what the value of closing a loan is. Um, everybody knows. Actually, let me ask you this: your seat of the pants value for a new customer coming across the threshold of a community-sized institution is if they come through the threshold wanting to do nothing but open a new account and apply for a mortgage. The bounty on that is 5 figures, right? Your cost of acquisition these days, I'd love anybody on this call to chime in because that's what I mean about co-creation. I have observed and love more data points to be adjusted here, but the cost of acquisition of a new customer in a community sized institution for just a checking or your share draft account, what, $300 to $500 is the acquisition cost?
Yeah.
Okay. The
Okay.
fintechs are spending $1,500 to $2,000 in VC money to acquire a customer. How can we ever compete with that? Not going to outspend them. My main client at my old company, when I was heavily in product development and lifecycle CRM, my biggest client was Motorola. And I was there watching Samsung and Apple outspend Motorola. It had nothing to do with the quality of the products. In fact, Motorola was cooking with gas. And then Google acquired them and tried to pour money on there. It was too late. Samsung and Apple just made it so the consumers fell in love with them. It's really difficult to outspend that. So we've got to have better products. We've got to have a real reason to walk back through the door of these institutions again.
And what kind of revenue? We talked a little bit about some of the intangible benefits to a financial institution, but what kind of revenue streams does something like this open up? And what's the model? Is it a subscription model?
Yeah, I contend that this is an enterprise SaaS subscription type of thing. If I get too close to things that feel like a rev share on a transaction, then regulated entities, hi Charles, may have a few things to say about that. It could be tantamount to payment for order flow. I want to stay as far away from that as possible.
Yeah,
Look,
makes sense.
if these are the types of people that are going to help me understand the pricing model, and that comes from understanding the value of reducing the risk on a lending event, right? That's going to drive the pricing. If we can facilitate more loans because the consumer has access to more capital at a better interest rate and to close faster, then it's simple arithmetic. If the institution does not want to pass on the reduced risk as a lower interest rate to the consumer, obviously they are making more money on the loan and revenue could come from that as well. So to be determined, I want to work out what's best and sustainable for all of us.
So maybe it'd be good to see if there are any questions from the audience because we've been talking here a little bit. This
I've
is
been rambling.
super. No, it's really good and super interesting. Would love questions from the audience, thoughts, and a model that you think's workable. Do you see any flaws in it? Is it something that is of interest? Because as I see it, you're capturing data, you're improving engagement, retention, and probably most importantly, you're giving them an opportunity to collateralize some of those assets that they already have. Any questions? So
I don't
I
know how to,
guess
I don't know how to take that.
you've wowed them. I've got a
I don't know.
question. How
My
close are
own
you?
imposter syndrome says the opposite because I'm always making sure I'm listening to everybody else. What were we saying?
Yeah, we've talked a little bit about that, but where was I? So trying to think, I lost my train of thought. Yeah, how close are you to having? Because I know you've been working on this solution for a number of years. How close are you to having something that can be brought to the market? When might we expect to see something like this? I know you're working with, like you said, CU Wealth Tech and a couple others. When is the launch date around something like this?
Yeah, my plan right now, and I'm working with a group that services the banking side as well. So CU Wealth Next is my go-to on the credit union side, and then there's another group that I hope to be able to talk about soon on the banking side. These channel partners, if you will, give me those alpha customers or co-creators that I really need to kick the tires. The most important thing is to not pretend like I've got it all figured out. I feel like I've done a very good job exposing a problem worth solving. I've spent I've spent many years understanding the regulatory environment by way of other companies that I've been with before. That landscape and one's approach to regulatory hygiene is number one for me. Because look, there's a reason I'm slow and deliberate, and that's that I'm very much not in jail, right? And a lot of these other guys are tilting windmills or taking advantage of areas that regulators haven't even contemplated yet. But when they catch up, what are these fintechs going to do? Go change their business model immediately? They can't. The VCs won't let them sometimes. So, so I'm being slow and deliberate to make sure to make sure to de-risk it for you guys. Sorry, I keep saying you guys because I'm old. Folks. There you go. Y'all. So to answer your question, I evaded it nicely, didn't I? I hope to be prototyping alpha testing with these friendly entities this fall, early spring. I think because I have done a ton of work, again, understanding my regulatory stance, and then more deliberately, at least for the last 11 months, more deliberately working with my DC law firm and some other regulators to de-risk, eventually inch my way towards a no action letter, et cetera. So I would not expect to go outside my friendly environment and testing with staff only until I've got some paper to point to from the regulators. And that process, who knows, spring, summer next year.
And just to
Oh, I have a question.
go ahead.
Yay. All right.
Oh, hey, Larry, Catalina here. Hi, Robert.
Hi.
Sorry, I didn't mean to cut you off, Larry. Please go
No,
ahead.
I'm excited.
I'll wait.
Speaking up.
Okay. So, Robert, thank you for sharing. I have a lot of questions, but I'm going to keep just to one. And it's
Yeah, sure.
outside of product, actually. It's more a cultural thing because you can look at the audience, right? We look at traditional finance. And I know you're addressing the regulatory aspects of it, which is great. Good for you, because otherwise you don't go anywhere. However, though, you look internally at the credit risk culture, right, of the industry. And I would say in order to successfully use your platform, if I understand it well, then the culture itself within the traditional finance would have to take into account alternative asset value, right? And have to then go in and say, hey, I know what the house is because the appraiser is comparing against all the comps in the market. So how does that work when it comes down to literally taking into account these other asset types? It could be venture capital investments. It could be all these different things that actually even to this point, they're not allowed to take it into account when they're underwriting.
Yeah. Thank you so much for that question because
Sure.
You're right. I glossed right over it. And I spent so much time talking about wanting to service the non-ultra high net worth people. And I'm so glad you brought that up because yes, that's a big point of this. And that is to say, forget investing with a capital I. But my friends at Concrete, and that's Concrete spelled CONCREIT as any REIT. What they've done is I hate to use buzzwords, but they've democratized and opened up investment for pretty much anyone. There's not a $10,000 minimum to get into a REIT or 6-month hold time. So they've democratized and opened up access to that to everyone. And I'm going somewhere with this.
Robert, that's real estate investment, right? For people who aren't familiar with what a REIT is.
Oh, sorry. Yes. Real estate investment trust. Basically, I think today and this is not promissory nor speculative nor recommendation. However, I think it's throwing off 6.5% yield, which in the ZERP days, that was huge. It's less huge now, but the point is a stable asset class, a historically well-performing asset class just got opened up to anybody. Catalina, what you asked swerves right into that. My model is designed to observe someone's behavioral patterns at a company like Concrete and see that if Jane has a good pattern and a habit of investing $20 every 2 weeks out of their paycheck into concrete. That's a signal right there. If you're making good decisions toward the future at any size, it's more about the pattern, the habit, and the intent. Okay. If you do those things and you don't go claw those assets back out every 4 months because you can't pay the rent, then one of two things. You might be putting a little too much in. You might need a little bit of broader education, or have the bank putting money in a high yield savings account at the bank or credit union because there's instant liquidity there might be better for them. So the point here is there's a lot of opportunity to educate people. And more importantly, there are a lot of patterns to
Yes.
understand. What is the intent of the person? It doesn't matter the
Yes.
dollar size. That's it. Now, there's plenty of alternative credit systems out there, especially in the era of the gig economy. I helped a company a few years ago that was focused on the gig economy. Then COVID happened and they lost their warehouse line of credit because COVID happened. However, they were on to the idea of, Stripe does a fairly okay job of being able to surface a person's account activity to a party that the person has granted access to. Not everybody has done a great job of understanding. Now that AI is in the world, it's probably a lot easier, but nobody had done a good job of understanding gig economy workers, people that weren't on a cadence that an old school algorithm could pick up. Does some deposit happen on the 15th and 30th, last of the month, or every other Friday? Oh, that must be their income. Those models, of course, have gotten smarter, but I don't think that's the be all end all of estimating a consumer's behavioral intent or self comportment, because maybe their evil insurance company is denying a medication that their child needs, and they're having to spend $1,800 and file paper to get the insurance claim paid. They're wiping out their bank account, but not for bad reasons. They're not going to the casino with money. So there's a lot of signals that aren't obvious in someone's ledger balance, and a lot of other things that can be introspected. Now, again, I'm taking a narrow focus because I'm not trying to create credit models or anything like that for at the broadest sense,
Yeah.
but I'm highly focused on, is someone paying it forward? Are they doing some things, irrespective of the liquidity horizon, almost irrespective of the risk, unless they're being highly aggressively risky at too old of an age, et cetera. But the point is, what is the habit? Does this look like a person who is really leaning into their future? And my answer to that, by the way, is yeah. If yes, then they shouldn't have to go liquidate some investment portfolio because they want a new house and they need to crank up the down payment. They shouldn't have to go erode that momentum that they've made. They should not call Vanguard and make a withdrawal request and pay Uncle Sam, et cetera. Now, again, I'm very careful not to be implying to be lending against a security, but increasing the surface area of data for all of you people out there to make a more informed decision on that person.
So, Rob,
Okay.
Today when a bank
Thank
or
you.
credit union, when a bank or credit union are making a lending decision, they're considering in-house data, they're considering bureau data. They're not necessarily taking into account a customer or member's other assets as either signals or as collateral. And that's what your asset-based lending platform does. Is that a good way of kind of summarizing it?
Yeah, it is. Here, I know we're running out of time. I'll share a slide. Why not?
Okay.
Sorry, I have too many tabs happening here. Yeah, I don't know if anybody else has had some issues with Teams, but I had to refresh about 6 times to get in, Larry. Is it sharing?
Oh, there we go. Yep. Yeah. Perfect.
Okay, so I have no idea what the scale of the slide is, but over here on the left in red, of course, I say this is the way it is. Banks and credit unions rely on in-house data. They look at the ledger behavior, the longitudinal data points that they gather, how many times someone dipped below the water line, et cetera. And what? CRA, big FICO or credit reporting. Data. That's it, isn't it? Because you just lived this, Larry. You had to make a spreadsheet. What? The provenance of that data. Let's say Larry's a bad actor and goes and breaks out Photoshop and forges his Vanguard statement. Depending on the
Could
level
easily
of
do that.
eh, 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 depending on the level of scrutiny and due diligence, those are signals until they're proven false that plenty of underwriters or those holding the pen would just smile and nod at probably. So let's remove a lot of that variability. But anyway, bottom half of the page, right? I've built a data model called reference model. The name says it all. That kind of extends existing valuation and other dimensions of things. That's the easy part. The easy part is to say, let's automate the things that Larry has. Let's give both the point in time value, the time to liquidity, the difficulty to liquidate it, the legal hassle of having to engage and grab something. Let's understand all those dimensions, put it into the risk models. We can bring the access to things, and we have to be very careful about not recommending things to consumers because nobody here wants to be promissory or recommendation or giving advice, advisory or promissory. So we definitely want to be very careful about that. But we can open up a conduit for that. And then again, the most aggressive part is the collateralization and really standing up a tri-party custodial contract with an arm's length third-party custodian. I will only work with ones that are highly technically oriented so that this can be as automated and bulletproof as possible. But yeah, Larry, that's the low, medium, high here.
I would think if you're
And
a
the contrast
financial,
between what people are doing now. What's that?
I would think if you're a financial institution, you're focused on financial inclusiveness. This kind of meets that to a T, right?
I think so. I think the story of Jane is a young worker. If she shows that pattern of $20 a paycheck into some investment product, I think that's a great signal.
Yeah, great.
And who cares what I think? I know I have almost completed the technology to let everybody, like people on this call, think that's a good signal or not. That's the thing. I'm leaving the risk recipes. I call them recipes because I definitely want to give people a lot of different dials to turn and a lot of ways to. If you look at the webpage, it's very important for me to show people they can put together their own underwriting processes that maybe only look at certain valuation models, that maybe only allow certain risk tolerances. But all that stuff, my goal here is to make all that data-based and configurable. So the institution can do what's best for them. Hey, all right, another question.
Hey, so I'm seeing this kind of a bullet here on collateralization. Just one thing that, and maybe I'm being cynical, but I would
That's okay.
worry about maybe low income users or people who are cash strapped using like banks using your tool to enable what would be like asset backed lending that maybe carries a lot of risk for the person who needs liquidity fast. So, suitability. Yeah, I think
I'm big
that's
on
something that I
suitability.
worry about. Yeah. Like,
Yeah.
just in maybe the idea that these contracts, I'm reading the bullet and it says automated contracts.
Oh, sorry.
Like,
I just turned.
no, that's okay. That's okay. When I see automated contracts, yeah, I would just worry that someone might say, okay, yeah, I want a loan against my car, not really even understanding that, oh, if you don't pay this, they're going to take your car. Does that make sense?
Oh, 1,000%. Look, listen, if I have my way, buy now, pay later, title loans, all that junk goes away. And how? I don't want to enable bad decision making because Catalina just asked the question about, I could tell she is counterpointing me on talking about people who are investing in private equity and things that are clearly like veering against the bell curve that I'm talking about here. So to serve the bell curve of everybody else in America, suitability is key. Education is even more key. You're absolutely right. When I say automation for the institution, I certainly think and aggressively espouse that the institution use this to strengthen their conversation and relationship with the customer, because there's plenty of direct lending things out there people could use. People can go get a payday loan with an app, and I want nothing to do with any of that. So certainly suitability is key, number one. And the second thing is, I could use the do no harm mantra, but the institution needs to not expose themselves to risk, whether it's reputational risk or legal risk. I certainly think, to answer your question, educating the operator, the institution, to not do things that are just dumb and risky for them is how that stops. Very little self-service is implied here.
Yeah, that's very clarifying. Yeah, I didn't mean to come across as accusatory. I was just
No,
more
bring
interested
it.
in how
No,
you
this is
kind
what I
of built
need.
your model around that. And yeah, I
No,
agree.
Henry, this
Conversations
is
around
what I
that.
need. I don't need people to tell me it looks good. I need people to poke holes in it so that I can build a better product.
Yeah, and I think that the mission makes sense, and I think that understanding a little bit more about how it's used helps me understand how it will facilitate that end rather than maybe being
Yep.
veered off course accidentally. So that's helpful. Thank you.
Yeah. Yeah. And a lot of that's on me because I'm super early here. This concept and this gap, the opportunity to fix something for this industry, that's born of really about 10, 11 years of either prior clients of mine or companies that I've advised and worked with over that span of time, aggressively in the regulated spaces. And it's been observing it. I literally, I canceled this presentation with Larry how many times? Because it was too soon. Actually, it's going to be coming up on a year of me telling him not yet. And I'm still way too soon, but I was too excited and just needed to start talking about it at a broader scale. But yeah, absolutely. I need the input. I need the co-creation observations to make this best for everybody.
Oh, good
Yeah.
for you, Robert. Keep going.
Thank you.
Definitely.
All right.
Rob,
Anyone on the call here that's in a regulated space that wants to either introduce me to the right interfaces at their entities, so that I can work towards things like no action letters, et cetera, please reach out.
And Rob, I did put in a meeting chat your email for anyone that's interested in reaching out to you or being part of a future beta test. I
Yep.
look forward to certainly having you on a future tech talk with a little bit more updates when you guys are a little closer to being live. But this has been really insightful. Always great to talk to you, and it's a really engaging
Likewise.
conversation. I know